So we continue with the person question. We are required to compute the budgeted profit for product E next month under marginal costing. We have the pro forma there, which starts with selling price. Our selling price, we are given $20 per unit. We are on the person question. We then subtract the variable production costs. In this case, we've got the direct cost of 6 and the variable production overheads of 3.50. So 20 minus 6 minus 3.50 will give us a contribution of 10.50 per unit. Since the question is asking us to compute the profit for the month, we then multiply the contribution by the total units sold in the month. The question tells us they budgeted to produce 5,000 units. They budgeted 400 units opening and 500 units closing. So to compute the cost of sales, we need opening inventory plus production minus closing inventory. So 4,000 plus 5,000 will give us 5,400 minus 900 will give us cost of sales of 4,500. We then multiply the 4,500 times the contribution per unit to give us total contribution of 47,250. Total contribution of 47,250. That's when we take out the fixed costs, which we are given as 29,500 per month. So 47,250 minus 29,500 gives us marginal costing profit of 17,750. What are the advantages of marginal costing? It's appropriate for decision making as it highlights contribution. So it is used in short-term decision making, because in short-term decision making we want to look at relevant costs. General costs, sunk costs are not included. Hence, marginal costing is used in short-term decision making. Fixed costs are treated in accordance with their nature as period costs. Okay, they are fixed, they will still be incurred whether there's production or not. Profit depends on sales and efficiency, not on production levels. Its advantages: there's a danger that products will be sold on an ongoing basis at a marginal contribution which may fail to cover the fixed costs. Because whether you like it or not, you still have to cover the fixed costs because you are still incurring those fixed costs. So if your sales are not covering your fixed costs, then eventually you run into financial difficulties. Marginal costing does not comply with IS2 inventory Therefore, at the end of the year, you'll be forced to make an adjustment in your published accounts as you value that inventory. Some costs are mixed in the sense that they've got a portion of fixed and variable costs. So where you've got such costs, then you must split these costs into their respective components of fixed and variable costs. We look at profits under absorption costing, under marginal, absorption costing. You have a pro forma there. Again, you have to memorize, differentiate these two pro formas, the one for marginal costing and the one for absorption costing. You notice the one for absorption costing does not include contribution. Instead, it has got gross profit, which is calculated differently from the contribution. The gross profits include the fixed overhead which have been absorbed. Okay, these are adjusted for any under or over absorption. We will be looking at under over absorption in a little while. So we're going to illustrate the differences in marginal costing and absorption costing. The same good time question we did, we also do it under absorption costing, so that you see how the profits differ depending on which method that you have used. You'll notice that in the cost card we now have fixed production overheads of 0.90, which was not included in the other cost card under marginal costing. The rest of the information is the same. The number of units produced, units sold remains the same. There is still no opening inventory. All variable costs were as per budget for the 2 years. We are required to calculate the total budgeted fixed production overhead. Now you remember the OIR formula. The OIR formula is budgeted fixed production overhead divided by budgeted activity. So in this question you are given the OIR as how much? The 0.90, that is your OIR. So using the 0.90, you could substitute your budgeted activity as per the question is how much? 12,000 units. You've seen the 12,000 units, normal budgeted production.
Yeah.
Okay, so you substitute in the OIR formula, we're able to get our budgeted fixed overhead by making that one the subject of the formula. So 12,000 times 0.90 gives us 10,800 as our budgeted fixed production overhead. You should be able to work the OIR formula forward and backward.
So for this, So this we didn't need to do the
So the total budgeted fixed production overheads, we get it from the OER formula, which we know is OER equals budgeted total production overheads over budgeted activity. We've been given the OER here, 0.90, and we've been given the budgeted activity there, 12,000. So substituting in the formula, our budgeted fixed production overhead is 10,800. It's clear there? We continue to compute the profit under marginal costing. All the information under absorption costing, all the information is as given in the marginal costing. The selling price is the same, the number of units sold are the same, so we still have 25,000 units times 13,000 units in year 1 as being sold, which gives us 325. We still don't have opening inventory. Our production costs is 280,000. Now let's explain the under and the over absorption before we proceed